Inflation, or price increases, of consumer goods and services has accelerated rapidly over the past 18 to 24 months. As measured by the All Groups Consumer Price Index Australia, that is the CPI, it first broke the Reserve Bank's upper target band of 3% a year in the June 2021 quarter, and then rose to a recent peak of 7.8% a year for the December 2022 quarter. While it has recently slowed, as of the June quarter 2023, it was an undesirably high 6% a year. Now, most people, when thinking about their financial futures, want to at least maintain their ability to purchase goods and services. That is, they want to be able to maintain their real or after-inflation spending. In the FinHealth personal finance software, all inputs are in today's dollars. That is, it's assumed inflation doesn't erode purchasing power. But with inflation at 6% a year, the spending power of $1 is reduced to about 50 cents in only 12 years. So, $1 million in investment wealth held now will need to grow to $2 million in 12 years' time just to stand still. Failure to accumulate sufficient investment wealth to offset rapid consumer price increases could result in some major undesired lifestyle adjustments down the track. And to compound the problem, while the CPI may be a pretty good indicator of the consumer price inflation experience of the average Australian, the reality is that everybody's spending patterns are different. Therefore, everybody's inflation experience will be different. In this video, we'll have a look at how the CPI is constructed to perhaps help you reconcile your inflation experience with the headline CPI inflation rate that the media tends to focus on. The following video will then examine the historical effectiveness of both fixed interest investments and Australian shares in terms of protecting your investment wealth against the ravages of inflation as measured by the CPI. Hi, I'm John Lesky, retired personal financial advisor and founder of FinHealth, a guide to good financial health and your financial independence. The chart on the screen shows annual movements in the All Groups CPI from September 1989 to June 2023. The Reserve Bank's target bands for inflation of between 2 and 3% a year and the average annual inflation rate for the entire period of 2.71% are also provided for comparison. In summary, while on average the CPI fell within the Reserve Bank's target range for the period examined, there have been some significant breakouts, with the most recent acceleration in inflation being a notable outlier. The CPI is a weighted average of the price movements of a number of major commodity groups or categories, which themselves are broken down into subgroups and expenditure classes. The weights given to each group that make up the index are revised annually based on household consumption expenditure data. The table now shown shows the most recent weights, that is for December 2022, for each of the groups and changes since 2019. Housing services, which include prices of new dwellings purchased by owner-occupiers, rents, renovations, rates and utilities, comprises the largest contributor to the index, followed by food and non-alcoholic beverages. The cumulative price movements since September 1989 for most of the commodity groups are shown on the screen now and compared with the cumulative movement in the All Groups Index. The prices of a number of commodity groups, e.g. alcohol and tobacco, education and health, rose much more than average, while others, for example, communication, clothing and footwear, were virtually stagnant or fell over the almost 34-year period. The prices of alcohol and tobacco products are now a little over 6 times higher than in September 1989, while prices for all groups are about 2.5 times higher. Relative to all consumer goods and services, alcohol and tobacco products are almost 2.5 times more expensive than they were in September 1989. Clearly, a person whose expenditure pattern was more heavily weighted, that is, in the representative pattern used to calculate the CPI, to alcohol and tobacco, education, health, would have a much different perception and experience of inflation than another who is more heavily weighted to communication, clothing and footwear. Some may be surprised that the housing group moved roughly in line with the All Groups index for the period examined. With housing prices always apparently rising, this appears inconsistent with actual experience. The primary explanation for the disconnect is that movements in the price of land, which is the main driver of movements in the prices of dwellings, are excluded from the CPI. Land is regarded as an investment or non-consumable item rather than consumption spending. The CPI measure attempts to capture changes in the price of housing-related services and home building, that is, things that are consumed. Also, consistently above average inflation rises in housing services are a relatively recent experience, as revealed in the chart shown now. It shows the same cumulative price movements in the commodity groups as discussed earlier, but for the 23 years from June 2000. Housing goods and services rose at an annual rate of 3.92% over this period, well above the average CPI rate of 2.84%. However, an analysis of the subgroups within the housing group reveals some large variations in the inflation experience. This applies to the subgroups of all the groups. The spikes in gas and electricity prices over the past 2 years, of which we are all aware, and which weigh heavily on our perceptions of inflation, are evident. While these increases are large, for the average Australian household, gas and electricity comprise only about 3.2% of their total spending on consumer goods and services. However, for those whose budgets are more heavily weighted to these essentials, the price increases are particularly painful. So, consumer inflation is a very broad concept. It's difficult to judge what's really happening from purely anecdotal observation. Both we and the media tend to focus on the largest increases in prices. So we generally think average inflation is higher than it really is. It's very hard to fully protect purchasing power against the largest consumer price increases that occur over time. Alternatives include reducing your consumption of these items and/or allowing for the past to be repeated in your spending projections. But how effective are your investments in protecting spending against the ravages of the average level of inflation? This is the subject of our next video. Hopefully you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. Finally, thanks for watching.